So if he goes according to plan at the $550 per year, he can do that, but at the same time, he does not have to. And that's of course where we monitor the plan over time, but that's the creativity we can do with life insurance. So year 10 cash value, I got so excited there, I forgot to take the year 10 values. Let's take a look here. So if we go back to that Excel chart, this guy displays an aggressive crediting rate using an indexed feature. Let's not look at that. Let's look at, if we go back to the illustration, I'm going to take more of a middle of the road example with the current dividend rate here. So year 10, I've got just 4.07. We're going to round up to 4.1 million and 8.9 million in death benefit. 4.1, 8.9. There we go. So what's happened in this example? Day one, we started with that $9.3 million death benefit. We cut it. We could have kept it at the 9.3, but we reduced it actually. And the purpose of that was really to optimize the cash value growth over time. Since the cash value is important, in taking these temporary reductions results in a greater long-term death benefit. But at the same time, 4.1 million in cash value, so that's in addition to the other assets he has, and then an $8.9 million death benefit. Powerful. Now, with this alternative plan, what do we got here? Age 55, $3.35 million in cash value. So before we looked at the life insurance, he had 4.95 million in assets. With the alternative plan, we took $1.6 million out of this plan and moved it over here. Now we did it in 3 years. So there's still an earnings rate over here, not really because it's in a bank account, but we did move it over in 3 years. We're going to assume for this example, we just move it all over in one shot. So that would take the liquid net worth of his present situation down to 3.35 and shifting it into the life insurance policy, which is still liquid, but you'll see where I'm going with this. So 3.35 of his present tax-free assets, which are very small, taxable assets, and also the tax-deferred assets. Personal savings, 0 to 50,000 per year, still allocated towards his other assets. We're just going to assume 0 here, play it conservative, and then company savings is still 100,000. Interest rate assumption, 4%. What's my age 65 balance? So we're going to do the same thing. Take the 3.35 million, age 55 to age 65, that is 10 years. At 4%, what's my actual total amount of money in those other accounts? 3.35 million. Paying in 100,000 per year. That's the company contribution at 4%. There we go. $6.2 million is what that will grow to. 6.2, okay. Not bad, but I've got less to work with now. Okay, so with the alternative plan, by age 65, in my tax-deferred and taxable bucket primarily, I've got $6.2 million. I do have $4.1 million in cash value life insurance, so I'm almost at the same $10.5 million. Similar, but a little off there, a little bit less. How am I going to maximize my income though? Because again, the purpose of this was to optimize the overall plan, not just keep me in the same position and leave more money through the life insurance policy. The life insurance does give you a lot of leverage. That's what we're going to touch on next. So having a life insurance policy as part of one's retirement plan does permit one to have the permission slip to spend their other assets more aggressively. Let's explain exactly how that would work. So age 65, we're going to assume I call it quits then. What were my age 65 assets based on the present plan before we looked at any adjustments? 10,500,000. Interest rate assumption, 4%. What was the income there? Let's use the before tax income. About $400,000. Just kicking off the interest, conserve my principal balance. Legacy at death, what happens here? The gross amount, that 10.5, is passed on. However, net after taxes, what is that going to come out to? Let's just call it $7 million. Depends on my situation. Could be more or less, really. Depends on where the assets are positioned and what state I live in, if I have a trust set up properly. There's a lot that goes into that. But a big bite is coming out no matter what. 10.5 down to 7 in this example. Now with the alternate plan, what were his other assets, excluding the cash value, and in both examples, excluding the real estate? Remember what that number was? If we go back, $6.2 million. That assumed the tax deferred and taxable accounts growing over time with a $100,000 per year contribution, which are his company contributions. So what we've got here, $6.2 million in liquid assets. Same interest rate assumption we're going to assume, 4%. Here is the fun part. So here's where we really want to focus. Here's how you leverage a cash value life insurance policy in retirement. And you can do this any age. If you're considering this, if you're retired already, hey, how would this work for me? Spending down other assets. So this $6.2 million, which is taxable. What happens to tax brackets over time? Where are they going to be in 10 or 20 years? I don't know. Nobody knows. There's always uncertainty. A lot of people don't like having taxable accounts because of that. So I'm going to take that 6.2, assume the 4% earning rate, and spend it down over 20 years. I am not going to try and conserve 1 penny of that account or those accounts. I'm going to spend it down aggressively. Let's take a look here. So I've got $6.2 million. I'm going to spend it down over 20 years. What does this look like? $6.2 million. Let's take a look. 6.2. Interest rate, same 4%. Number of years, 20 years. So this is going to take me to when? Starting at age 65, 66 technically, up until 85. Will I still be alive at that point in time? Most likely, right? So I am going to spend the money deliberately during the golden years of retirement. That's where I'm going with this. So when I first retire, I've got more energy and such. I can go out, I can spend time with the family, with the kids. This is when I'm going to spend my income down, my assets down. When I'm 85, will I still be going at the same pace I was when I was 65? Maybe. Maybe I'm like Clint Eastwood. He's 90 and still going. He had a great diet all his life. But what's the likelihood of that? I might be tired, slowing down a bit. So we're going to spend down those taxable assets when we can enjoy them to the fullest. All right. So let's take a look here. What does this allow me to do? Look at that. 6.2, about $440,000 per year, 438. So took the same 6.2. Income's about the same, a little bit higher. Of course, I'll have more tax there, but still, let's call it 440. Look at that. So income now, retirement income, $440,000 per year. With the 10.5, it was $400,000 per year. Very similar here. Now, the drawback to this 440 is 85, you're out of money. On the example on the left, you still got $10.5 million. Yeah, here's the difference. Cash value, we still have that policy. It is growing the whole time we're spending down our other assets, 65 to 80. Now remember, with a whole life insurance policy, when it's structured right, set up properly, I've got the guarantees associated with the product. Guaranteed to go nowhere but up. We looked at the guaranteed values. No matter what happens, it goes up. So if there's fluctuations in the market, an economy tank, I don't have to worry about that. Peace of mind exists, keeps on going up over time. So I'm going to let it sit in the back burner. I have access. It's available the whole time for opportunities. At age 85, what's my cash value and death benefit? Let's take a look. Let's go back to our Excel chart and look at our retirement plan here. So we've got the middle of the road scenario. Let's look at this on the left, growth only. $550 per year, breaking even year 4. Started at age 55. Age 85. What do I have here? Total input was still the $3.4 million. Cash value balance, 8.675. We're going to round up to 8.75. Death benefit, look at that, $10.6 million. Except for, well, before I get ahead of myself, 8.7 million in cash value, 10.6 in death benefit. 8.7, 10.6. Okay, so if I die, what's passed on income tax-free? The death benefit. Life insurance proceeds are passed on 100% income tax-free to my beneficiaries. Perhaps I'm leveraging some equity in my real estate to stretch it a bit longer. I could do that in either scenario, really. But 10.6 in death benefit, what would I rather pass? This or a big pile of taxable assets? It's a no-brainer. That death benefit, if legacy, is very important to me. Cash value, I've got 8.7 million remaining here. Going back to the current plan, I had 10.5. Now, as I continue to take those $400,000 interest-only distributions, I do have income tax on that. If I take distributions from this 8.7 million, how much income tax or capital gains tax or any tax do I have to deal with? Take a guess. 0 tax. If it's not a mech and I take out my distributions properly through a combination of withdrawals and loans, I don't have to pay the loans back. It's got to be done properly, but you can pull it out income tax free. This is, by the way, what so many big corporations do with executive benefit planning and cash value life insurance when they create their own, call it private pension plans. That's not compliant at all, but that is exactly what they're doing when you really look at it. Now, to continue on with this plan, what I want to look at here is, let's assume we're still going strong. 86 to 100. Let's assume we live to 100 years old. What does the income look like? And then what does my death benefit look at age 100, depending on how much income I want to distribute? And going back, here's what I want to keep in mind. Going back to this guy, the retirement plan, the current plan, the income was $400,000, but that is pre-tax. I may net after tax what here? Remember what we came up with when we did this math? $280,000, assuming 30% of it goes out the door to taxes. Let's dig in here. So, on the left, we've got our growth plan. On the right, starting at age 86, we're going to look at 2 examples here. So starting at 86, one option, pulling out $300,000 per year. This is income tax-free. This is based off of a conservative present dividend rate, not the aggressive assumption we saw. I don't like doing that. Much better to set expectations more conservatively. This way we know it will last. It's people's money we're dealing with here. You've got the $300,000 per year coming out. How does my cash value look? I'm spitting off interest here, so yeah, it's barely coming down. And here's the beauty of it. So we saved the best for last. You don't have to do that. You can do a combination of distributions. Some people like to take income from their other assets and then dip into the life insurance policy to supplement income as they'd like. Again, everyone's different. But here, barely coming down, but you're taking $300,000 per year out, and you've got that huge tax benefit. With the $400K per year based off the other example, the 10.5 million, we net less than that. That's beautiful. If I die at any point in time, income tax free, look what is paid out. This is assuming I die after age 85, and I want to pull out $300,000 per year. This can be adjusted each year as far as how much I want to pull out. Then we ran an aggressive example. Let's pretend that we say, you know what? I want to pull money out and spend it on my family, have as much fun with them while I'm still around. Let's do exactly that. I'm going to pull out $500,000 per year tax-free aggressively. Look at this. There's too much money in here too late in the game, which is great. If I die at 100 in this ultra aggressive scenario, that 3.7 million is passed on tax-free. So NICE means to leverage cash value life insurance, something I can certainly look to consider. If you have questions on it, reach out anytime. We love this stuff. Most we work with, I will let you know, have a laser focus on the cash value insurance product itself. Hey, show me how to design it properly. That's what I'm interested in. But can definitely do this kind of stuff as well. Have discussions around it, and we've got absolute professionals that can help in this field too. Depending on how much I pull out really and when I die. 7.9 million in tax-free death benefit there. 10.6 before age 85. Beautiful. So some things that often come up here, questions you may be thinking, wish I would have started this 10 years ago, depending on my age. Well, the good news is you easily can. The earlier you start, typically the better. But one thing that's fun to do is to say, okay, I wish I would have started it 10 years ago, but interest rates are higher back then. If I've got a big pile of money in cash or other assets, like I actually see it earning, what would it have looked like if I did start 10 years ago with life insurance run at the conservative rates today? What would that have looked like? If I can kind of take a look back in time, can do that. Take some time. Those are going to be case studies we are working on and will have in the near future. In the future, I shouldn't say the word near. What if I'm over 60 and retired already and I'm not cash flowing any money into savings? Can that work? The answer is absolutely. It is 100% a repositioning of assets in that position or in that situation. So what I'm doing, if I have a bucket of cash, let's say I have the same net worth as this individual, I'm 65, I'm not 55, but I'm not saving $300,000 per year. I've got different buckets of money. How do I maximize my situation? Well, what I can literally do is transfer a portion of assets I have, whether it's tax deferred, I have to account for the taxes there, taxable, perhaps money in cash, whatever it might be, shift it over to a cash value life insurance policy, and then look at the same distribution model. Here's my current plan, here's my alternate plan. How does it look at the end of the day? You know, there's a saying that people tend to believe more what they can see, not just what they can hear. We like to see it. This is all whiteboard too. I mean, you can go much deeper than this, but I'm going to try not to get into that now because I do that too much with the life insurance. So it's a repositioning of assets and then maintaining or increasing retirement income. We want to make sure that we can enjoy our retirement and not have to worry about things. To kind of close or wrap all of this up, I didn't touch on this, is using the money. So with a cash value life insurance policy for this 55-year-old individual, he wanted to do more than just reposition the balance sheet for great long-term success. He is interested in other things, in business ventures, in real estate. There's other avenues he wants to explore. That's a big reason he's got money in cash. Cash is great for opportunities. That's what he's doing. Now, repositioning it into the life insurance policy, he can do the same thing. Here's a demonstration of just that. On the left, you've got the same policy we've looked at, middle of the road assumption. There's the 550 per year, then the 200 through year 10, which by the way, he can stop altogether after 4 years if he wants to. Break even point or cash on cash, year 4. Non-MEC all the way through. Why we see that death benefit drop in year 7 has to do with that MEC testing. It's called the 7-pay premium test. We've got more information on that. But here we go. Cash value continues to grow. Now, what does it look like when I actually use the money? When we hear about policy loans, how do loans actually work? Because when I say the word loan, what comes to your mind? Payments and interest. With a policy loan, do I have payments? Optional. I can never pay it back. If we go back to those retirement examples, we were using loans at the end of those income scenarios and not paying any income tax and not paying anything back. What happened is it does reduce the death benefit and cash value, but that's what a lot of people do with policy loans. My point to saying that is we do not need to pay them back. In this example, we're going to, and there is interest as well. So here, we're going to take out a $1 million loan. Let's assume a fantastic opportunity opportunity comes up, it's real estate, or maybe I'm investing in some technology or something like that, having some fun. What is the impact of that policy loan? Here's my cash value. What happens here? Break-even point still year 4, but here's what I want to highlight. What do you notice? I'll often refer to the cash value as, call it, a line of credit. That is the equity that determines how much money you can actually pull from a life insurance policy. So when I pull $1 million, I'm at $2.2 million. Now how much am I at? $1.2 million, I should say. So I see that reduction of $1 million. Now, here's the beauty of it. The insurance company, when I take a policy loan, the company will continue to pay me dividends on any money in cash value and on my outstanding loan. So when I pull money out, there's no lost opportunity cost there. I continue to receive dividends and interest, just like if I were to borrow against an appreciating piece of real estate. If I've got a home and it appreciates at 5% every single year, and I take a line of credit against it or a mortgage, if that fair market value goes up by 5% every single year, it doesn't matter if I own it free and clear or if I have a mortgage outstanding. I get the 5% appreciation on my appraisal value. Same thing here, only I've got guarantees that it will continue to go up over time. So how the insurance company does that is as follows. Look at the far right. What do you notice there? Compared to this guy, death benefit drops from $9.3 to $8.3 million. So the insurance company tells you and I that, hey, Steve, if you take a loan against your policy, we're going to continue to pay you dividends and interest. But here's the thing, how we do that is, 1, we collateralize your death benefit, dollar for dollar reduction. So if you die with a loan outstanding, we pay out the death benefit minus the loan, and there is loan interest on it as well. The loan interest in this example is 5.66%, which does go to the insurance company. Always good to be aware of that. However, we're still earning interest on it too. Now, here's my loan balance, $1 million. What we're doing here, we've got the loan interest, $56,000, 5.66%. Then we've got the interest payment. So in this example, as the interest comes due, we're paying it. Then we're making a principal payment of $200,000 per year. We can pay back the loan however we want. It does not matter. We can pay it back over 50 years. What you will find when a loan is repaid, let's just zoom down to the bottom here. What do you notice about your cash value and your death benefit in this example? In fact, let's go 1 year after when it's fully paid off. Cash value and life insurance values are restored to exactly what they would have been as if I never touched it in the first place. Slightly higher here, actually. The reason why it has to do with this insurance company's dividend treatment, when I take that loan, they pay me a higher dividend rate on borrowed funds. If you'd like more information on that, let us know, or check out our non-direct and direct recognition videos. That gives a thorough explanation of how that works. My point is, though, is that there's no lost opportunity cost. So as this individual, this 55-year-old individual, is investing in his overall financial plan to make sure he's got the right retirement plan set up or strategy set up, he can still use his money for other assets, which just enhance his overall position. Now he's got more to work with, which is great. Can have some fun with this too. So hopefully you enjoyed this case study. Very thorough, very in-depth, a lot we didn't go through. As time passes, we're definitely going to have more of these. Some will really dig into the nitty-gritty details as far as, hey, if I stop my 401k, I don't get a match anymore. I don't have any company contributions, different situations, because everyone's unique in that situation. And it's good to see information, what it looks like. If you have any questions, would like to see any custom proposals or plans for yourself, reach out anytime. We'd love to work with you, talk to you, help out however we can. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like,
and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.